thank you to everybody that has joined or has joined in the last couple of minutes. This is our second webinar of our West One commercial series. My name is Sam Pettit and I'm the Regional Account Manager for West One, supporting our intermediaries across the north of England and up into Scotland, across our bridging, development and our commercial mortgage products. So our commercial team is based up in Manchester, and we have Craig Sanders who joins us. He is one of our telephone BDMs. So if you've dealt with the team, you spoke with the team, had any new inquiries, that you've picked up the phone to the guys in Manchester, then you most likely will have had a conversation with Craig at some point. It's his priority to make sure he's having terms back into your inbox ASAP. So we've got Craig on the call with us. Hi, Craig.
Hello, everyone. Welcome.
And then we've also got one of our senior underwriters, John Brown. So John, he's got around 8 years experience in the underwriter role, with over half of that dealing specifically with commercial mortgage cases. So we've got two really experienced individuals on the call with us today. So there's a huge opportunity here for everyone who has joined us to ask your questions, so we can get those answered for you today. So like, as I said earlier, any burning questions, the chat screen should be live for everybody. Please do throw your questions into it. I'll either jump on them throughout the session, or we'll look at revisiting them, any that we've not managed to cover off towards the end. So please do use that, because that's a big opportunity for everyone. Okay, so with this being, the second in our series for the commercial webinars, today is all about pinpointing where we can support you and how. The particular kinds of deals that may be causing some headaches, the areas in the market where we are seeing most of those opportunities. And as I've said, answering those questions for you, should you have any for us live today. So plenty of opportunities for us to be able to cover off live with you. So I thought it was well worth also covering off. So if you weren't with us for our first webinar, so our head of sales, Jez Quinn, really comprehensively gave a good introduction for us in the commercial space. So how our journey to launch into the commercial space, which is a really, really exciting time for us. So if you haven't seen it, it is on our YouTube channel. You can go and have a look, and I'd really recommend that you do, because it's a really nice entry level where we are in that market, our USPs, and where you would be picking up the phone to us, and our journey into that space. But I mean, look, it's always well worth me giving you a quick summary for this, for those that weren't on the call. So at West One, we are the home of specialist lending, and what we mean by that is we are looking to cover all angles for you when you're dealing with your customers, and looking to provide them with specialist finance solutions. So for us, with us having operated for over 20 years in that short-term lending space, so offering lending solutions across both our bridging and development products, the next step for us was to branch out into that longer-term market. With that starting off with buy-to-let, moving into second charges, and now with the residential mortgage proposition as well. So, naturally, the next step there was to explore that commercial mortgage space as well, and looking at where are those gaps in the market, where can we really launch something into a landscape where those gaps are, and we can really add value to our broker partners. So that's absolutely what we've done, and we're really, really excited with what we've launched and the success that it has had to date. So I think it's worth just summarising where we are in that market. And there's a number of gaps that I've just mentioned where I feel like we do pick up a number of pieces of business, and it's going from strength to strength, month on month, new inquiries through the door, deals turning into applications, and ultimately funding. So to give you an idea on where we sit, you ultimately have your high street lenders, you have your challenger banks, and then you have your more specialist lenders. Now there's this gap in the middle where we are ultimately coming in, and where we are ultimately pitching ourselves is that price versus service area. Okay, so I was having a really interesting conversation with Duncan the other day, actually, on sort of turnarounds, average speeds to completion, and why we're why we are where we are, and why we're being so successful. And at the moment, one of those figures that came out was that on purchases, we're averaging at 3 months, and on refinance we're averaging at 2 months. That's incredibly quick within the mortgage market space, where others of our competitors are maybe going anywhere between maybe 4 to 6 months, maybe longer as an average. And I'll come on to the reasons as to where we are able to shave that down. That is a huge advantage within the commercial mortgage market, particularly where you might be on tighter deadlines. So we absolutely should always be forefront when looking at those opportunities. But when I say price versus speed, we're not pricing too far off where those challenger banks sit. So when we're looking at both commercial and semi-commercial, we will consider both types of property or a mixture of the two. Our rates are starting in the 7s. So on our semi-commercial products, we start from 7.09. And on our full commercial products, we start from 7.69. Okay. So I think everybody can agree that that is incredibly competitive, especially combined with the service level that we're producing and the turnaround speed to completion. So hopefully that gives you a really quick rundown of where we are placing ourselves in the market and why. But the pricing bit is particularly important combined with that service. It gives us a really unique position that realistically means that we can consider all types of deals with a relatively, competitive rate to be able to produce for you, combined with moving that through to completion and funding as soon as possible. Okay. So one of the ways in that we do that is that we have very tight SLAs, which both Craig and John on this call adhere to. And I don't think we've broken it as yet. So we have a really strong 24-hour SLA in place across every key stage of our process, okay? Whether that's new inquiry through the door, whether that is new application, documents being returned, queries throughout the process, everything that our staff do within the Manchester office covering that commercial base is at 24 hours, okay? So it just means we've got that constant momentum, okay? There's nothing worse than someone going away to review something, taking 3, 4, 5 days to do so and coming back with the answers for the other person to do the same. You very quickly lose that momentum. So for us, it's incredibly important to make sure that that is a continuous process. Everyone's in the know. Everyone knows exactly where they're at in terms of requirements outstanding, at which point all players within the process are at. Solicitors, valuer, us, client solicitors, yourselves. So it works very well for us. Something else that I think is particularly important there's a few angles here. And I think when we look at, when we reviewed the gaps that are in the market and where we wanted to pitch ourselves, there are a number of areas where we want to make sure that we are adding value. So another one of those is loan size. So for those of you that are actively writing business within that commercial space, you will know that that sub 150,000 kind of area is particularly restrictive. So we've come into this market lending from 50,000 and above. Okay, so that is a particularly important space in the landscape of the commercial arena. And we are ultimately seeing a lot of business on that side of things because it is so restrictive. So anything in that sub 150 space, lending from 50,000 upwards, we absolutely should be forefront of your mind for. That's not to say that we won't do the larger loans as well. So we will lend up to 5 million. Anything over 1 million is on referral. So please do clue us in for your larger ticket mortgages as well. Another area, which again, I think is particularly underserved in the market, is that lack of experience piece. So where we're coming in is the types of things like your new starters, so businesses, new starters, or lack of 1 year's accounts, maybe even just first-time buyers. So it might be actually they've only ever rented for their commercial premises and now they've got the opportunity to purchase, or it might be a startup business where they actually need a commercial hub to start themselves. Or it could be that they're an investment landlord but never had that commercial property, they've only ever invested in residential. So there's so much opportunity in that area where other lenders would dip out on that lack of experience piece. So absolutely, we should be having those conversations if we're not already. Valuations is also a really big one for us. So for anyone that doesn't know, when we're looking at valuation and leaning on the figure that we will ultimately lend from, a lot of lenders, a lot of our competitors will lean on the 180 day. So the vacant possession 180 day figure that's reported back. For ourselves, we'll rely on the vacant possession, the market value vacant possession figure, not the 180 day. And that can make quite a bit of difference. Okay. So definitely bear us in mind for that. I think the majority of what I'm seeing at the moment probably does fall into those three areas. They are three really big areas for us. Craig, just to come to you for a moment. So to explain everybody that Craig's role, Craig sits front of house for us within our Manchester office. So he'll be, as I said earlier, if you've not spoke to him, but you do have an inquiry, it most likely will be Craig that you've spoken to in the past or will do going forward, being one of our telephone BDMs. And he fields a lot of these inquiries that are coming through. So I think it's always good to hear from, internal parties to what they're seeing. But Craig, look, give us an idea of what you're seeing on the front desk. Common inquiries that you're receiving, where you maybe see those opportunities are and where we're being successful in winning inquiries. I know I've probably covered off a few of those already, but it'd be great to hear from your point of view. Anything additional there that you're seeing quite regularly?
Yeah, so as you mentioned there, Sam, you have covered quite a few of the main ones. I mean, one of the biggest things is obviously the commercial market recent years seems to just be booming. It's a huge increase in the amount of deals, new investors entering the market. So a lot of the deals that we are seeing are new investors. And as you kind of touched on, it might just be a smaller loan size to get them started, get them onto the ladder with the commercial elements. But it could just be, like you say, with trading accounts, it might just be a new business or got lack of experience because they want to enter this commercial space. I mean, one of the big things we are seeing at the minute, and this kind of leads on to a lot more people entering the market, is a lot of people who are coming to West One, they may be using the likes of bridging to buy a new investment property. They could be doing like a big refurbishment to self-occupy it as an owner-occupier, even as investment. When we say, obviously, we are the home of specialist lending, we like to retain as many customers as we can. So one of the big things that we are seeing at the minute is we are turning out a lot of our own bridges. And then given we do consider a lot of the lack of experience, it's not a problem for us. I mean, when it comes to like the bridge and exit side of things, it could only be trading for 6 months because they've just done an extensive refurbishment. They may not have that trading history that some lenders may require. I mean, some lenders out there may require at least 1 or 2 years trading history. We apply common sense. When it comes to trading accounts and stuff like that, we can heavily rely on projections, and we will consider using 100% of those projections, whereas I think some lenders out there may be capped. They may only use the likes of 90%. So then they are being limited with some lenders, whereas we will use the full potential of that business. Another point may be the likes of first-time buyers. Again, as long as there's a common sense approach and there's some level of experience behind them, even if it's going to be someone who wants to go on their own cafe business venture is a good example, as long as they've got some elements of industry experience, we understand they've got a level of management where they know what they're doing, they know the day-to-day business, we can then look at projections and things like that. So not only lack of experience and less than 1 year's trading history, we do consider the likes of first-time buyers, which some lenders may not, because obviously it's a huge risk there, but we are happy to take them on board, especially if it's investment, because at the end of the day, self-funding deals speak for themselves. We'll rely on the leases in place. I mean, one of the other kind of pitfall side of things where we do see issues with other lenders is the likes of affordability and previous year's trading. So you could have a property where a landlord's owned it, let's say 10 years, they have a great connection with the tenant within, and they've not increased the rent, or they've increased it at a minimal rate over the 10-year period. Now, if our client's purchasing that property, you've got property there that is on a very low rental income. So when it comes to affordability, you could then find issues, passing the minimum stress test with some lenders. With us, again, it's all about that common sense approach. So as long as the client will draft a new lease, for example, we can rely on drafted leases. Or even if it's a full new lease, we can rely on those. Obviously, we still lend on the lower of the passing rent and the market rent, but it just kind of shows we've got that flexibility. If it's got a poorer previous trading history, if they're looking to change that, improve the situation, we'll apply the common sense. We will use the latest documents. We can use projections. So with ourselves, it is a very common sense approach. We don't have the likes of minimum lease periods. It's just basically understanding the deal and knowing there is potential.
Brilliant. You've covered off so many points there, and some really, really fantastic ones as well, including that lack of experience, including around valuations, including around serviceability. The option to maybe pull in a draft lease so we know what we're going to be, from a serviceability point of view, what we're going to be relying on and where the income's going to be generated from within that first year. Lack of trading history. Something else that we've looked at recently was vacant units. I'm assuming that's the same kind of thing when it comes to doing draft leases and getting those signed prior to completion.
Yeah, exactly that. So again, it's just the common sense approach. So if you have got like a property where it is fully vacant, at the end of the day, we are lending on the market value with vacant possession. So the figures are all tailored around that approach. But when it comes to the rental income, obviously there is none at this point. The way we would approach those types of deals where it is fully vacant, we would just be led by the valuation. So for example, we'll obviously get a market rent. That will be the rent that we will rely on, but then we'll have a look at things like the tenanting period. So let's say the valuation may say 3 to 6 months for tenanting. Even though we don't top slice on fully investment third party tenant deals, we will make sure the client can at least service our loan whilst the tenanting period is being dealt with. So let's say it's 3 to 6 months. If our client can evidence the funds for that 3 to 6 months, they can cover our loan payments. We're happy to still proceed with those deals, knowing that they are looking to tenant the property actively, and we can rely on the valuation for that.
Amazing. I think there's nothing more flexible than that. Look, that, a great response, Craig. Thank you so much. There is no better explanation when we're saying a common sense approach. How are they going to service the loan? We can prove it via X, Y, and Z. And we can, the deal does work, whereas other lenders ultimately would probably dip out at that point. So loads and loads of opportunities there. Fantastic. Thanks, Craig. Just to jump across to John, please. So when it comes to, because I know you mentioned, Craig, like no top slicing. However, if it's an owner-occupied situation and we are looking to maybe use a bit of background income, John, just to jump across to you, can you give us a bit of an idea as to how that would work on serviceability? Whereas other lenders, ultimately wouldn't look to top slice at all, how we can utilise that as a function on an owner-occupied basis to service the mortgage?
Yeah, so there's a number of ways we can do it. We can look at accountant certificate. So we always have the conversation with the accountant, and it's using the company net profits, any income they take from it, whether it be dividend or just a salary, and if they have other rental income, that could be evidenced via SA 302s. We're taking things all into consideration when there's an application and making sure it's serviceable at that time. We'll factor in all these. If they're not self-employed and they've got a partner who's on the application, 3 months worth of pay slips is sufficient. We could take that into consideration as well.
Brilliant. Yeah, look, I think that covers that off in a nutshell for me as well, because look, we get a lot of queries when it comes to top slicing and fitting affordability. So where we won't consider that on an investment basis and we are looking for the rental to cover it, when we're looking at owner occupied, so the borrower's own business, there's loads of opportunity actually to be able to make that work, as John has highlighted, via an accountant certificate, using their income that they're taking from the business, or potentially partner as well if they're on the application. So loads and loads of ways of looking to make that work, which is fantastic. Thank you very much, John. Okay, so look, we've covered off a fair bit of basis there, although in a really, really short time frame. And hopefully there's people in this call that are already starting to think of cases where they may have had struggles in the past due to policy or criteria of the lenders and where it's kicking it out. Has there been, let's have a quick look. Have we got any questions that have dropped in? I think I may have seen one. Let's have a quick look. Thank you very much, Kit, for your question. So you're querying about the specialist care sector. It's definitely a big area of the market. There's no two ways about that. So C2C, 3B use is an area which West One support on both investment and owner occupied. Example being portfolio landlord who has previously let his properties as C3 on ASTs, then getting change of use and letting on C2 basis, largely driven by demand, the longer term commercial lease, higher rents, etc. So we're struggling to find lenders who will use the commercial rent being received when calculating debt service. Okay, so thank you, Kit. Thank you very much for your question. So in regards to that, when it comes to that care sector, it is a big area of the commercial market. Currently at the moment, for our lending appetites, we aren't, that type of asset isn't something that we would look, that is within our appetite currently. Craig, John, I don't know whether you've got anything you want to add on to that to cover off that question, but
I would agree. Obviously, at the minute, the appetite wouldn't include the likes of C2, any kind of like care facilities, unfortunately, unless it is like an office to a care company, but then that wouldn't obviously have the C2 use. We just can't consider, unfortunately, the properties where things are happening on site. Just to go to the latter about obviously the rent received, things like that, when they are owner-occupied deals, and this may or may not answer the question, but I'll just throw out another positive. If it is an owner-occupied deal and there is rent being paid, let's say it's OpCo/PropCo, we will again look at the accounts and we will factor things like the rent back in, which will further increase net profits. But at the minute, just going back to C2, it isn't something within the appetite, I'm afraid, as you mentioned there. So
brilliant. No, perfect stuff. And you know what? It's a really valid question because, look, us entering the market and people getting a feel for where we are, what we're lending on, we are seeing a fair bit of it. So we definitely know that it is a big area in the market. At the moment, our appetite isn't there on those types of property. So, but no, thank you very much for your question. So we've also had another question from Joe. Thank you very much, Joe. Who do we use for valuations? John, would you like to cover that one off for us? Who are we using to instruct valuations through?
Yeah, so we currently have two panels. We have appraisers where we can get our quotes from, and we also use Vast Panel. So we have a broad range that they can go out to on the market. You know, you each have different relationships with surveyors, but yeah, the two panels that we use are appraisers and Vast.
Perfect. Thank you very much. And there's possibly another question here for you, John. Thank you, Panate, for the question, asking for our approach on historical adverse for the client. So to cover that one off very briefly, when we're looking at adverse credit within our commercial mortgage proposition, we are pitching ourselves towards the cleaner type of client. So it's more situational circumstances, property type, income, etc., where you will probably see the deal. When it comes to heavy adverse credit, we're not in the market for that. However, we do have criteria around historical adverse where we can accept blips and where events can be explained away. So setting that up for you, John, can you give us a bit of an idea as to where we sit on that adverse credit piece?
Yeah, depending on the type of adverse, if it is an odd payment missed here and there over the last few years and there's a plausible explanation surrounding it, you know, it's something we can consider. CCJs, you know, if it's for a parking ticket and it's satisfied, it's something we can overlook, where your higher CCJs that are unsatisfied are probably outside our criteria and our appetite. It's just about that common sense approach. If we see there is historic adverse, so, you know, outside the 4 or 5 years ago, if there's plausibility surrounding it and there was an explanation and all the remaining credit is clean, you know, it's something we can consider. And as I mentioned, you know, if it is the odd missed payment over the last 12, 24, 36 months, and there is an explanation surrounding it, it's something that we can get comfortable with. It's just as a case-by-case basis, really. If they do have any and it's referred over to someone like Craig, the terms, if they've got a copy of the credit profile, 9 times out of 10, the underwriter will have a look at it and see where we can get comfortable.
Brilliant. And we do have essentially 2 tiers on our products, don't we, when we're specifically looking at adverse credit. So W1 and W2, meaning that we can accept, when we're looking at that historic, where we would place them on our product guide. We'll make sure our product guide is shareable, by the way, post-webinar for anybody that hasn't already seen it. But it's very, very clear and breaks down exactly what credits that is acceptable to us. But that's not to say that we won't look to be flexible. So by all means, if you feel like it's, worth a conversation, having Craig and Josh front of house and the support of our sales team as well, who I'll cover half off who's looking after what region, always worth a phone call. We'd much rather have the conversation and understand the scenario than you not pick up the phone at all. But just to give you a bit of an idea, so no CCJs or defaults within the last 36 months, no secured arrears within the last 24, highest of 1 unsecured arrear within the last 12 months. And then when it comes to things like IVAs, bankruptcies, liquidations, none within the last 6 years. Okay, so hopefully that gives you a bit of an idea if you need, but thank you very much for your question. Got another question here. Do we have a set of documents where we can check the price for valuation for various clients? So it sounds like you mean maybe like a tiering system on valuations for dependent on like property value. I believe that's what you mean, John, but don't believe that's the case. It comes down to quotation via the panels on application. Would I be right there?
That's correct, yeah. So they don't kind of provide us with a list of potential price ranges. It's just we'll input the data into the VAS panel or appraisers. They will provide us with a minimum, usually a free quote, and each valuation firm varies in price. So you could have lower end of 15 up to 2,200, depending on the type of property and also the area and the surveyor himself.
Brilliant. Okay, lovely. Yes, perfect. So that, I think that does answer your question. You've just messaged me back. Lovely. And then another question that's just dropped in. So appetite when it comes to retail units, such as fish and chips, a laundrette / dry cleaning business. So fish and chip shops, it's a regular for us. Vape shops as well, they're popping up all over the place. We've done a number of those, which I know other lenders won't particularly be keen on. There's lenders in the market that aren't particularly keen on anything that's sort of noisy, smelly, etc. We will consider those. Craig, John, did you have any comments to make around fish and chips, laundrettes, dry cleaners, and where our appetite would be, maybe max leverage wise?
So there's no kind of we've got 75% on the likes of fish and chip shops and retail units. Your laundrettes, we restrict the LTV slightly to 60%, but on other retail units, we'll go up to the 75% for purchase and 70% for refinance. But the only one we really kind of restrict out of that list is your laundrettes, which are capped at 60.
Brilliant. And that makes me think of one that we did have the other day where it was a mechanic's garage with a pit. Again, a number of lenders probably wouldn't consider something like that. John, in your experience, max leverage on a unit such as that?
Depending on the condition of the rest of the unit, you're looking up to usually between 60 and 65% if it does have a pit.
Brilliant, brilliant, lovely. So look, everyone, when we're looking at these types of assets that probably are a little bit more niche, other lenders are dipping out of entertaining them at all. Where we're coming in there is providing that opportunity to lend. It may not be at the highest leverage at 75%. However, if they've got the funds to be able to invest and we can go to 60, 65%, there you're in. There's the opening door to be able to help your customer, because not all lenders are going to be in it for those types of assets. We're happy to assist, we're happy to support, but it just might not be at that max leverage end. So anything like that, get in touch with the guys at the office, and they will always put their best foot forward on those kinds of deals. Okay, so look, I think that's been really, really valuable so far. I think it's also worth just covering off process for everybody as well, and diving into that a little bit more for you. So you know what to expect from us, the support available, the process, what that would look and feel like if you're using us for the first time. So I've already mentioned that one of our biggest USPs is our turnaround time and the speed at which we work. So touching on our process should help bring that to life a little bit as well. So everything we do, as a reminder, is at a 24-hour turnaround point across all key stages. Okay, so when we're looking at new inquiry through the door, you've got our upfront team that are assisting you, Craig and Josh, and they'll be chatting through that deal, making sure they understand it as you understand it and putting their best foot forward on terms. If it's something that is maybe a little bit more unusual, we will always look at it on a referral basis. We're more than happy to have those conversations up front with, people that have those decision-making abilities on something that's a bit more unusual, to make sure that the terms that are landing in your inbox are worth what we're putting forward. So inquiry through the door, you've got Craig and Josh that are picking those up. Craig, I know that turnaround times to get terms into any of these guys' inbox is absolutely phenomenal. I would probably say it's second to none in the industry in terms of issuing terms and making sure we're absolutely on it so you can go back to your clients as soon as possible. But Craig, from your point of view, how, turnaround time, how quickly are you kicking out quotes?
Yeah, so very quick. Here's my answer. So one thing we hate to see is a pile of, whether it be email or a number of calls coming in. We like to be very responsive with them. So when an inquiry comes in, typically speaking, we like to come back to you within the hour. It may even be quicker. If we are very on top of things, you could be having terms sent straight back to you within 30 minutes. At its worst, you're probably looking 2 to 3 hours, and that's probably on one of our busiest days. Obviously, we have the excuse of the 24-hour SLA should we ever need it, but our approach isn't based around that. We'd like to get the work done. We're not here to just sit and chat around. We're here to get business done for you guys. So, yeah, I'd say if you've got an inquiry, send it over to us. 9 times out of 10, you're going to hear back within the hour or quicker. A very rare scenario, you may be looking at max 2-3 hours. But yeah, our approach is if you've got a deal, even if you've got a meeting with a client, which we get quite a lot, a meeting with the client at 2 p.m, it's currently 12:30, we'll have full terms issued way before that meeting. But yeah, you can rely on us for speed, especially when it comes to you presenting to clients. We want to obviously build that relationship with you so it makes your relationships with the clients stronger. So typically within 1 hour is what we like to keep it at.
I love that. Look, we go to the market pitching 24-hour turnarounds, but that is across all key areas. Okay. So our upfront team providing terms into your inbox within an hour, the majority of the time, is absolutely phenomenal. And I know it because I see it day in, day out, the terms that they're producing. So sometimes it's, you've got to try and test us to feel the speed and the service that we are actually kicking out. So hopefully hearing it from Craig and him putting his name on the line for what he's doing day in, day out, you absolutely will try us in the next. But no, it's absolutely spot on. 24-hour SLA, but ultimately, none of the guys are sat waiting for 24 hours. We're absolutely on it. So you've got your terms in your inbox. You've spoken with your customer, they're happy to proceed. You've got the documents, so they'll, on terms being issued, there's certain minimum document requirements for us to take that to application. Okay, so returning those to us, you've got an underwriter's allocated to that case. They will be picking up the phone and having a conversation with you and chatting through that deal. So John, to throw you a question, within that first 24 hours of a new application being submitted, let's say you're allocated to that case, what within that first 24-hour period, what does that look and feel like to the broker in terms of submission checklists, and bits like that? What would they expect to come back from you?
So it would depend really. It's obviously case by case basis, but as the underwriter will go through the whole application form, the property itself. if it is owner occupied, if they're providing us with the income, we usually have those conversations with the accountant straight off the bat, so that we can get comfortable and there's no kind of delays further down the line. It's all about, I think the best thing for us is if we get everything submitted day one, we can give pretty much an explanation and get the valuation quotes out to a broker that quick. Because valuation quotes can take anything up to 24 hours to come back. Sometimes they're a matter of 5-6 hours. So if it's in the morning, everything's okay with the application, we can get the quote sent over to a broker after having that conversation day one, and get that instructed day two. That's how quick it can be as a process.
Brilliant. So let's say all documents are returned. So broker's got it absolutely nailed down, provided all documents day one, you're going straight out for valuation quotes. I think it's a really, really good point to highlight to everybody when we're looking at opportunities and how we're looking to support and service the brokers in this market. And one of the ways in which we're turning around things so quickly to funding and completing is at the point where you've got that valuation quote and they've paid for that, you've got that level of commitment from the borrower, we are instructing solicitors immediately, right?
That's correct, yeah. So as soon as that valuation is paid for, we'll instruct the client solicitors to get the ball rolling on the pre-loan inquiries. That can save you 2-3 weeks in legals.
Absolutely. Perfect. I think that's a point well made. Okay. So where other lenders would wait for the valuation to return, on which sometimes can be quite a complex, very long pagey report, and that can take maybe 2-3 weeks in process to have that fully submitted and back and reviewed, we're already on it when it comes to the legals. And as you'll know, the legals within the commercial space is that bit lengthier when you're comparing it to residential and buy-to-let, the likes of. So the fact that we're off the mark that bit quicker is incredibly important, and what serves us very, very well in being able to fund your deals that much quicker. So definitely one to remember for West One. Okay. Solicitors is a really good point as well. Again, another topic of conversation a lot, particularly on commercial, is the solicitors that your borrower is working with. Okay. There is a huge difference that we see when we're transacting these cases over solicitors that are experienced, having transacted commercial mortgages in the past, and those that are maybe qualified for the job that doesn't have the experience of doing so on the commercial side. So one of the examples that someone presented to me the other day was a £3 million office block. So huge valuation report, lots of legals to jump through, but ultimately everybody was on the same page. Our solicitors can work as quickly as the borrower's solicitors. And in this case, the borrower's solicitors were very, very experienced. And it meant that we could actually turn that whole deal around in 2 weeks, which is phenomenal. So to pass through legals and get that all tied up within 2 weeks for a £3 million office block is absolutely the kind of thing that we can deliver on for you. You've got maybe a 100 grand semi-commercial that is a very, very straightforward deal, but the borrower's solicitor isn't that experienced, maybe takes a week at a time to review each set of inquiries that come back, and you already, that process becomes a very, very lengthy one. Having us, dotted all the I's and crossed all the T's, legals working very, very slowly. But our legals that we work with, they will ultimately work as quick as the borrower's solicitors. So it's very, very important that if you're recommending your borrower's solicitors, that you've maybe done a bit of due diligence over who they're going to be speaking with. Okay. But look, from there, we're ultimately moving to completion. So happy days, client satisfied, and there's been payday, and everybody's happy. So, and that is the aim at the end of the day. So yeah, look, that'll give you an idea of process. To round off what we've sort of chatted through in terms of USPs for us, so the touch points across inquiry, like cradle to grave, 24-hour and everything, turnaround times for inquiries, application and offer. I think I've already mentioned it. We're 3 months on purchases and 2 months on refi to completion. So absolute game changer in our space. Each case is assessed on its own merits, as Craig has really, described very, very well in his examples, it is a common sense approach that we take. And we will look to, we will look how we can make a deal work with maybe other assets or other bits of income, or we want to be very flexible. Criteria is a criteria. However, have that conversation, pick up the phone to the guys, let's chat through the deal, let's understand the deal, let's understand their experience, let's understand their income, and see if we can make that work for you. Referrals, we rely heavily on referrals for that as well. If it's not something that's A1 through our criteria, let's have that conversation. So we'll look to make a decision day one on referral before we put those terms out to you to make sure they are worth the paper they're written on. Okay, we've touched on rates. We start in the 7s across our commercial and semi-commercial, so very, very competitive in that space. The sub 150 market is incredibly important for us. We're lending on the vacant possession figure, not the 180 day. Lack of experience is a big thing for us. We'll look to utilise all kinds of income, anything in that kind of space. I think we've covered that all off. And then when it comes to payday for you guys, we pay 1.5% across all of our cases on commercial. Okay, lovely. And because I'm a bit conscious we are running out of time, I also wanted to cover off a couple of case studies, which I think just helps bring these kinds of cases to life. It gives a bit of meaning behind what we're actually saying and where we're winning deals and why. This first one that we've got up on the screen now, so a 266 £1,000 mortgage on a complex sale and leaseback deal. So look, scenario here. So we've got an office unit, so a commercial office property that was valued at £425,000. The client was experienced, strong background, property professional, just purely looking to diversify their property portfolio into that commercial sector. Okay, so experienced individual, but not necessarily within that commercial space. The original deal was going via review with another lender who ultimately withdrew their offer. Okay, so following receipt of their valuation report, it was deemed that it was unacceptable. The valuation report itself, the assumption of a potential 12-month relet period falling outside of that lender's credit criteria. Okay, so the sale and leaseback structure with this deal as well introduced an additional complexity and did create what was ultimately a time precious scenario for them to be able to source an alternative funding solution. Okay, so that was when they approached us. So when we reviewed the case, we were looking at an overall leverage of around 66-67%, structured as a sale and leaseback scenario. So the existing owner and tenant remaining in occupation on a 12-month lease after the sale, which, look, provides an initial income stream from day one. So that's a really good, again, a common sense approach to be able to review that and deem it, see it as that kind of opportunity. So one of the benefits here, and something that we do see fairly often, is having already produced a valuation report by the means, and us being able to take a view on that, and whether we retype it and go via the valuers for comments. So a key advantage of this particular deal was that we did rework a version of the original valuation report to avoid the need for a full revaluation, reducing both what was the time element and the additional cost to the borrower. So we were able to complete the purchase without incurring those additional costs, which is always going to be a bonus. The structure of the deal provided immediate rental income while securing that commercial asset to generate long-term income and capital growth for that individual. So they were very, very happy with the outcome of that. Ultimately, not only did we save them cost, we were still able to complete within the time frame that they had, having already explored and gone through the process with another lender. So hit the mark on that one. It was a fantastic case, not a huge loan size by any means. However, we got very, very good feedback on that one from the borrower and from the broker that introduced it. So look, where I'll finish for everybody is understanding what support you've got available. So For ourselves, for our sales team, we divide the country up across multiple regions, and you've got dedicated sales managers. So not only do you have the support of the individuals within our office in Manchester that are directly writing and structuring and hand-holding on your commercial mortgage deals, you also have a team of individuals supporting you from a sales perspective. So to quickly cover that off for you, we've got the lovely Olivia, Parrot and James that are covering across central and north London and the surrounding areas. We've also got Paul, Tom, Ali and Abel that are covering off the city and southwest, and again those more southern areas. We've got our Theo and Nikki that are covering southeast London, Essex and Kent. We've got the lovely Iona covering off Midlands, East Anglia and our North Wales patch. Alan that is covering off southwest and the remainder of Wales. And you've got myself that covers right across the north of England and up into Scotland. We are all very much available. Our contact details are on there. They're on the website. Please do reach out to us. If anybody wants to have a further chat one-on-one, go for a coffee, or have a new deal that you want to chat through, whether that's in the commercial space or short term, so bridging and development as well. All of us do cover those three products. So pick up the phone or email us, or if you want to arrange a time to speak or meet, all of us will be more than willing and happy to have that conversation. But look, I'm cutting it really fine here. Thank you so much to everybody that's joined us. I really hope that's been beneficial and has highlighted where we sit in the market, the opportunities there, and the reasons why to pick up the phone and have those conversations with us so that we can support you on your next deal. So thank you very much. That's the end of the session. Goodbye, everybody.